As we leave behind a week that saw Donald Trump's inauguration and a raft of executive orders, you'll be fooled in thinking that the main event of the month has already happened. But this week ahead sees a huge amount of economic data and corporate earnings. I've provided a separate video for those earnings with 4 of the 7 Mag 7 names reporting. But also, we've got 3 central banks reporting with the likes of the ECB, the Federal Reserve, and the Bank of Canada all coming out with their latest monetary policy decisions. So first and foremost, let's just jump into the outlook for the sort of big ticket items for the week ahead. And like you can see, things kick off on Monday with the manufacturing and non-manufacturing PMI numbers out of China. So we're going to be shifting our focus onto China once again. Of course, we just heard from Donald Trump recently where he essentially said he didn't want to have to enact tariffs on China. And certainly this outlook about the potential 10% tariff is lower than many had expected. So we've actually seen some optimism on that area following a period of time where, of course, we've been seeing significant uncertainty come into play. Then we see the focus on the US with the core durable goods coming out on Tuesday, and things really ramp up on Wednesday. Inflation out of Australia, consumer confidence out of Germany. We've got GDP numbers coming out of the eurozone, and then we see the Bank of Canada with the first rate decision of 3, the Federal Reserve also on that same day. And Thursday, we've got the ECB coming out. Excuse me. So the FOMC, the Bank of Canada, the ECB, all reporting within the space of 2 days. And then we wrap things up on Friday with a focus on inflation data. We've got inflation out of the likes of the German region leading into next week's eurozone number. And then we've got that core PCE price index from the US just to sort of tie things up in a meaningful manner. So let's stick with the US and take that as our first of 3 themes. And like I said, we've got a whole raft of economic data coming out, starting off with core durable goods and the consumer confidence survey on Tuesday, and ending the week with that core PCE price index. We've got the GDP number coming out on Thursday as well, whereas an expectation it's going to move a little bit lower to 3%. And essentially in the middle of that, we've got this FOMC interest rate decision. Now, markets expect nothing when it comes to a rate decision. You know, there's pretty much no chance that we're going to see a rate cut this time around. And part of it comes down to the idea that the Federal Reserve is going to be hesitant. There's all this talk about data dependency, right? Data dependency is great, but also there's policy dependency, right? What's Donald Trump doing and what's the impact to the economy? There's too many question marks at the moment, and the economy is too strong. Right, the economy is growing at a good clip. They don't necessarily have a reason to be forced into cutting rates once again. And there's significant question marks around inflation. And that's why wrapping up the week with that core PCE price index number, it means that, you know, it's not going to be the case that only the FOMC meeting is the big ticket item for the week. In actual fact, you might see bigger volatility on Friday than you see on Wednesday, depending how things play out, because certainly that inflation gauge is going to be absolutely key in terms of providing expectations going forward. So this is the outlook for core inflation. Excuse the title here. I forgot to change that. So core inflation here, we've got PCE, core inflation, and we've got the CPI. So core CPI, core PCE. What we can see here is that the CPI number's been moving higher after that very strong December monthly reading. And that continues on a trend where we've seen those monthly gauges, those green bars, increasing time and time again. So that is worrisome, right? And then you look at what's happening in terms of core PCE, where in actual fact, we saw a nice move lower in terms of that November figure, taking the heat off a little bit after a couple of strong months. So the question mark here is, does it follow that trend of the core CPI figure and rise sharply? Or do we see another low number? Another low number this time around would be good news for markets and point towards a possibility of further rate cuts from the Federal Reserve. Let's look at market expectations. Expectation is at 0.2. That would be fine, quite frankly. If you're rotating between 0.1 and 0.2, then you're heading back towards target. If you're posting 0.4s, then you've got a problem. And thankfully, the markets are going to realize that core PCE is more important than core CPI. And as long as this number comes in at a decent level, 0.2 is fine, then things are, heading in the right direction. You can see that at the bottom with the annualized figure, that PCE number at 2.2 at the moment. And if we see a 0.2, then we're likely to continue on that trajectory where it points towards things really coming down to a very manageable level once we see those coming few months stripped out. As you can see in the middle section on the left, January, February, March, April, they've all got pretty hefty monthly figures that are above that 0.2 figure. And so when they're stripped out, which means when May comes around, where are we going to stand? Well, as things look at the moment, we're going to be down to around 2.2, and that should be enough to allow the Federal Reserve to do what they want, really. But also it's given them enough time to sort of realize whether Donald Trump's policies are inflationary or not. Now, if you're looking at expectations, right now the base case scenario is for one cut this year. And what we have seen, interestingly, over the course of the past week, is a gradual move away from the idea of zero rate cuts, away from the idea of one rate cut, and gradually, very gradually, towards the idea of 2 rate cuts, 3 rate cuts. Some of that comes off the back of that lower than expected core CPI reading out of the US. But certainly there's a little bit of optimism being built in there. And Friday's PCE number is going to be key to that. Of course, the Federal Reserve meeting will also be very important because they lay the groundwork for expectations going forward, even if we're very unlikely to actually see them cut rates. So it's going to be more around the rhetoric and the words than the actions itself. So in terms of the US dollar, we can see here that it started to roll over, and that is a blueprint that has been followed last time around when Donald Trump came into power. A lot of fear at the beginning, the surge in terms of that haven dollar, and then it rolled over and we saw a protracted, pretty much a 12-month sell-off for the dollar. Well, we've started to see it roll over here as well. And it's not to say that suddenly we're going to see a massive amount of rate cuts from the Fed. But at the moment, markets are pricing in this idea that we're pretty much not going to see any easing. We're maybe going to see one rate cut this year. And I just think that's maybe a little bit too pessimistic. As we've seen previously in terms of the core PCE price index number, there's a good chance that we get back down towards that 2.2 level by May. And in which case, if we do see a rate cut in the first half of this year, then we've got the whole second half of the year where inflation might be considered tamed, depends on how things play out under Trump, for the Federal Reserve to be able to ramp it up. So there's a good chance we could even see 2 or 3 rate cuts this year, with the back end of the year being the time where they can do the bulk of the action. But we're going to be talking about equity markets, and you can see here in terms of the S&P 500, what drives the S&P 500 by and large is strength in terms of earnings. So earnings per share in the light blue line, the 12-month forward earnings per share, which essentially counts sort of future earnings as well, in the darker blue line. What you can see here is there's a sharper slant higher for the 12-month forward earnings per share, which points towards this growing optimism as time goes on in terms of where we will be in the future. And you can see at the bottom now, we have seen this growth in terms of the price to earnings ratio, and that highlights why you can see a steeper slant in terms of the S&P 500 in the orange line compared to those earnings per share line. But nonetheless, the fact of the matter is the stock market can do well even if the FOMC decides they're not going to cut, right? As long as the economy is doing well, because when you're talking about the possibility of keeping rates where they are at the moment, a lot of the uncertainty or pessimism that you might see throughout equity markets comes off the back of the idea that keeping rates where they are will be detrimental to these businesses. But what if people don't necessarily believe in that? What if people are believing that the economy is so strong and that the policies under Trump are going to be so beneficial that the Federal Reserve don't necessarily need to cut to the same degree? That would mean that people rely more on your likely, say, 12-month forward earnings per share sort of trajectory, and less so on the idea that, like, we're going to see a rate cut and that's why I'm going to buy into this particular stock or into the market. So we do have underlying trends which should be beneficial for equity markets, even if the Federal Reserve don't necessarily cut. And therefore, we're going to be looking at the likes of the Nasdaq here and trying to see exactly where we could be going from here. So the Nasdaq, of course, heavily focused on big tech. And big tech's going to be absolutely key this week because we've got the likes of Meta, Microsoft, Apple, no, not Apple, Tesla, and and Apple reporting. Sorry, so 4 of the Mag 7 names all reporting over the course of the week. And so, tech is going to be at the forefront of all of this. And so, as we can see here on the hourly time frame, gradually climbing higher. Let's look on the wider context. Very nice, clear uptrend in play here, and we're on that next leg higher. We saw the rally around the election, then we saw the pullback that lasted around about a month, and now we're back in bullish mode once again, crucially breaking up through your near-term swing high, which was the 21703 level. And so, even if we were to pull back, I think that this sell-off phase is essentially done now, this descending wedge, it looks like. So we've got this wedge formation, and now we've broken out from it. And so the bulls are back in charge. We certainly do have a possibility that we've sort of now told the market, yeah, we're done with this wedge. The bulls are back in charge. But now that we've broken up through resistance, maybe we do retrace and then head higher. Maybe we don't. And that's where that sort of hourly time frame comes into play, because you've got this trend line support in here, and then you've got the creation of higher lows. A breakthrough trend line support and through this support level that we have here, which is around about a 217,700 kind of area that we had drawn previously. You can see here. So essentially that price swing high now turns into potential support. You can probably see it best on a 4-hour chart. There you go. So resistance turns support. As long as we remain above that level, then there's a good chance that the bulls are going to remain in play. And yes, the Federal Reserve might come out with comments that warn off the idea that they're going to see a huge amount of rate cuts. But quite frankly, markets are pricing 1 rate cut at the moment anyway, and it's a guessing game, right? They're going to be data dependent. They can't necessarily say that Donald Trump is definitely going to be really inflationary. So they have to hold off. And so, yeah, it's probably going to be a patient approach, but I don't necessarily have a problem with that. And I think equity markets are standing in a good position as things stand, irrespective of the Fed. So then we're looking at the eurozone. Like I said, the ECB rate decision on Thursday, that's going to be the big event of the week. But we've got alongside that German IFO business climate, consumer confidence from the GfK out of Germany. We've also got on Thursday the GDP numbers coming out of France, Germany, the eurozone unemployment rate, economic sentiment, and we've got that rate decision from the ECB. Then German retail sales, German inflation, and French inflation. So a big focus on Germany in particular this week. And that comes off the back of a raft of PMI numbers that actually came out pretty strong, sort of bolstering the idea that the economy is going to move back into a more positive period. Certainly, they're not out the woods, in particular in the manufacturing sector. But, things are starting to sort of look a little bit brighter in the region, certainly. And so we're going to be looking out for some of these data points to sort of point us in the direction of whether that is true to form or not. Now, we've seen some strength off the back of that PMI report, in part because this idea that, this poor eurozone is going to need the ECB to just cut time and time and time again. Maybe that's not necessarily going to be the case. Maybe it is. I mean, they've done a lot as it stands. And you can see here, markets are expecting another 25 basis point cut from the ECB. Notably, when we're looking at the DAX, we continue to see it push into record highs. And you can see here, in terms of the price to earnings ratio of the DAX, it is relatively overextended. So there's going to have to be some sort of pickup in terms of earnings or earnings expectations, certainly from the German economy and from the German businesses to justify this continued move towards the upside. But certainly with the economy starting to take a little bit of a positive turn, if we do see the ECB stick to this idea that they're going to continue to cut rates time and time again, that alongside an economic recovery, that makes for a good environment. But if that economic recovery comes at the detriment of interest rate cuts, that could be detrimental because then it starts to undermine the recovery. Well, markets currently pricing in 100% chance of a rate cut this time around, with a 4% of that attributed to a 50 basis point cut, which very unlikely, as you can see here. But crucially, things are very different from the likes of the FOMC, because you can see on the March meeting, we've got 81% chance of a 25 basis point cut, 3.4 of a move down to 2.25. So essentially, you've got 85% chance of a cut in March as well. And then you look into April, and we've got a base case scenario of another cut down to 225. And then if you look from then onwards, you start to get a little bit more indecision, where people think we're probably by the end of the year going to be seeing a cut into 2%. So that means 1, 2, 3, 4 rate cuts expected for this year for a bank that already has been easing to a large extent. And that coming against a backdrop of things starting to look a little bit more positive over in the eurozone. Well, if you look at the likes of the DAX, you wouldn't necessarily think that things have been looking too pessimistic, because we've just been going higher and higher and higher. This is the monthly time frame, right? It's absolutely rampant. And this month in particular, despite this all this talk about Donald Trump potentially enacting tariffs in the region, people don't really seem to care that much, quite frankly. And you can see here in terms of this uptrend, we've got this nice creation of high highs, high lows. And this is exactly what you want to see from a market, right? You just continue to clip these higher lows time and time again. And you're just creating those high lows, higher highs. And that points us in the direction of this current pullback being a likely retracement. Now, what I would say is that we don't necessarily see sort of wider retracements within this. What we're often seeing is the rally and then consolidation, rally, consolidation, rally. We're not seeing like your 76.1. It's probably not really a point in even drawing the fibs. What I would say is there's different ways to play it. And so one way, if you're looking at this type of move, is to look for shallow retracements. And so, we can see it, say here, if we were to draw one onto here, you can see it's a 23.6, right? It's not, we're not talking 76.4s and things like that. So we're going to take the shallow retracement zone and say, all right, well, if we're just seeing a 23.6, then we can wait for that breakout through the price swing high and then look for long. So on this occasion, because you've got such a shallow retracement, stop losses below your price swing low aren't necessarily far away. And so you'd be looking, if we're looking at this as a sort of breakout move, let's say you were taking it there, putting stops below that prior low, let's say it's down there, for where it got up to in the end, you're talking a 2.79 risk to reward. So let's say someone was just riding this trend and just doing sort of 1-for-1s or 1.5s, 1-for-1s, you're talking about a move just down to here. So pretty easily attainable. And then the 1.5s, we're sort of around this area here. So again, we surpass that quite easily. And you can do this kind of thing all the way up, and ultimately you're looking at different retracements and what that tells you about the market and whether you break up through the price swing high. So let's look at it in terms of the context of the current move, right? So we've seen this rally pull back into probably a 50% retracement, consolidation, big rally here, and now we're seeing a pullback. We're coming in towards this trend line support. So if we were to see a shallow retracement, then we'd be looking at, let's just get that out of the way. You'd be looking at a move in towards maybe the 38.2. We've already moved past the 23.6. So let's say we come into here. If we then rally up through your price swing high, which is 21530, then we could potentially look for positions on that. Ultimately, you're looking to ride this trend. And the key thing here is that at some point the trend ends. And when would that trend end? Well, for the time being, it'll be a move through this 21211 swing low. If that happened, then we'll be looking for a wider retracement to come into play for this index. But certainly, as things stand, things look very strong, and it's pretty much a straight line story at the moment. But the weakness we're seeing at the moment comes off of the idea that the stronger PMI numbers could lead us into a position where the ECB might take their foot off the gas. And that's why this meeting's going to be so important when it comes to the ECB this week. And finally, let's talk about Canada. Canada has got its interest rate decision as well. That's on Wednesday, prior to the FOMC meeting. We've also got the likes of the GDP numbers coming out on Friday for both November, which is a confirmation, and December, which is a preliminary number. And so let's look at those numbers. So we can see the previous figure, okay, 0.3, the previous figure for the December one, you can see minus 0.1. The expectation for the expectation for the November one is minus 0.1. So not necessarily seeing Great performance in terms of the Canadian economy at the moment. And bear in mind, we've only just heard from Donald Trump, who's talking about 25% tariff on imports from Canada. So there's this sort of bearish bias at the moment anyway. Then let's look at inflation. If we annualize the 6-month inflation, monthly inflation figures from Canada, we're at minus 0.2. If we do the 3-month, we're at 0.2. So Canadian inflation is pretty much non-existent at the moment, and you can see it here in terms of the core metrics. It's 0.5 on the 6-month and 0.3 on the 3-month. So there's plenty of headroom for the Bank of Canada to move into when it comes to rates, and not thinking that they're overheating the economy. And we can see here markets are expecting a cut down to 3%, so a 25 basis points cut from the bank. You can also see here in terms of unemployment, the Canadian line is the highest of the lot here, and it's moving higher at a pretty rapid clip. So sharp rising unemployment. We've got the question marks around Donald Trump. We've got inflation pretty much non-existent. It all points towards more action from the BoC, and that's exactly what markets are expecting. 90% chance of a rate cut this time around. The next cut after that is expected to happen in April, and by the back end of the year, we're probably pricing ourselves maybe just like 50 basis points below where we are at the moment. So market's not expecting a huge amount when you compare it to the likes of the ECB. They have already done a lot, but certainly there's a possibility that we could maybe see this adjust more in the direction of further cuts this year, which could provide potential weakness for the Canadian dollar. In terms of the pair I'm watching here, we're looking at the likes of EURCAD here. Let's just bring that up. EURCAD pulling back a little bit at the moment, but certainly this comes off the back of a rally in towards this big resistance level that we've got here. So we've got this zone of resistance around about 1.505 kind of area, and we've tagged it once again, but now pulling back. The question mark is, are we sort of topping out here, or are we continuing this wider big trend? So let's see it here on the weekly time frame. It's relatively choppy, but we're pushing towards the upside. We've come off the back of that strong data coming out of the eurozone in terms of the PMI numbers. Is that going to be followed up by a more patient approach from the ECB? Are we going to see the Canadian central bank taking on a more dovish approach, despite the fact that markets pricing in 50 basis point cut? Do we see more? Well, right now we're seeing this pullback. I think there's a good chance that we do see this as a retracement and that this bullish trend continues. But ultimately, let's see how price action plays out. If it breaks through 149, then it starts to look like this rally is over once again, respecting that big resistance level. But if we break higher, then it looks like we could be challenging resistance once again in a bid to break through and continue the bullish trend that's been dominating recent weeks, and also the back end of last year. We saw this rally in the back end of November, moving into much of December, where we saw this pair rallying before that New Year sell-off that we saw for EURCAD. So plenty to sink our teeth into, a big focus on central banks, but also inflation for the week ahead. My name is Joshua Mahony, Chief Market Analyst at Scope Markets. Make sure to like and subscribe for more content like this.